So trouble ahead. So I think one of the biggest issues when thinking about markets making money is the fact that we went through a period of 15 years of artificially low interest rates. And I think the consequence of that was with very low interest rates, it created bubbles in stocks, in bonds, and in real estate. And now we have had not only the Fed raise interest rates, longer rates have moved up, but the period of adjustment, I actually believe, is going to be a multi-year adjustment. And there are some other things that I've observed, and I'll go through quickly. One is that the risk premium using the Fed model, looks like it's breaking down, which is often a good indicator.
How are you?
Okay, Rich, I'm going to have to mute you.
Forgive me for being a road warrior here.
Okay. Also, we saw that Fitch downgraded debt, and Moody's downgraded some banks, and for good reason. And a lot of it relates to the adjustment associated with interest rates. But Janet Yellen said the downgrade by Fitch was totally unwarranted. And I had to dig up the quote. Fitch's decision is puzzling in light of the economic strength we see in the United States. Yellen said, I strongly disagree with Fitch's decision. I believe it is entirely unwarranted. On August 2nd, a week ago, and her comment is obviously political, but if she really thinks that we got nothing to worry about, we've got a real problem. I think a great example of what that problem is this chart that I have of what the federal government has to pay its current expenditures in terms of interest payments on our debt. And that they have now risen to $1 trillion per year. And to put it in perspective, when I was in college, it was maybe a couple hundred billion, and now it's at $1 trillion, and it's rising quite rapidly, and it looks like a debt snowball that we are playing with. Nobody wants to say it. Certainly nobody who is in government. Certainly not Joe Biden talking about Bidenomics. But the reality of it is we've got a lot of debt out there, and I think that Janet Yellen can't seriously believe that this is unwarranted. One great way to look at the market, I think, is the Fed model or the risk premium model, which takes a look at the 10-year U.S. Treasury yield, and it then compares it to the earnings yield on the S&P 500. And what I noticed here is that actually that has started to drop fairly significantly. And we really have two risks. Our earnings going to roll over because we have a recession, or our interest rates going to go up. But in either case, it actually takes you back to, I think, 2002 or something crazy like that, to have a risk premium that suggests equities are expensive. But they are, and I think that situation could get worse. It could get worse if interest rates move higher. Another thing that anyway, another way to look at it, trying to articulate the bear case for equities, is the Buffett indicator. What that does is it takes the GDP and compares it to the market cap of the Wilshire 5000. And currently we are at about 150% of what we normally, what norm we are at, what our historic norm might be. And I think that the period we're looking at reminds me of the early 70s, when the market went into a downtrend, and at the same time commodities did very well, and you saw that the market cap of the Russell 5000 declined significantly relative to GDP. This happened again from 2000 to 2008 during the two market declines at that point. And my fear is that we could see the same thing happen. And the beauty of Buffett's indicator is, you're comparing paper assets versus kind of hard assets, real assets, earnings, the GDP. And which I think kind of demystifies it and really points to the fact that low interest rates, I think, have created a bubble. One other way to look at the market is with Shiller's CAPE ratio. And what I like here is the comparison relative to 10-year yields on the US Treasury. Since 1981, they went from 15% down to 0.5%, and they've recently moved up. But right now, we're looking at a PE ratio on a cyclically adjusted or 10-year basis close to all-time highs. Comparable to 1929, higher than 1901, 1966, other historic peaks. But you could justify it had we with low interest rates, but those low interest rates are now in the rearview mirror, so that really gets to be the issue. I've taken a look at or overlaid the S&P, the triple Qs, and the Dow, and really you had a huge run here in the triple Qs. It ran up, it peaked, it pulled back, but we've had this big run here. And if you ask me, it reminds me of the tech bubble having survived an initial crack in March and then ultimately topping out in August and then rolling over. And that's what my concern is. I think that there was a lot of hot air around artificial intelligence, and the Magnificent Seven all really enjoyed great moves, drove the market higher, and I think that that gave people a great deal of comfort. And when people have comfort and there's no risk, they don't see any risks, those are often the periods where your risks are the highest. And just to look at the VIX, which is a good quantitative objective measure of what the option market says expected volatilities are, or implied volatilities. Back when the market was bottoming last October or November, we were up around 35. It got down to 12 and has started to move up with the Russell and Moody's downgrades. Another thought that I believe makes a lot of sense is the idea that we are in an inflationary commodity cycle. And this chart may be a little difficult to read, but we had an inflationary cycle in the 70s. We had another one from about 1999 to 2011 or 2000 to 2008. And during that period, gold and oil just took off. And same thing happened during the 1970s. And I think that these are the likely outcomes that we will see going forward. Another way to look at it is a ratio between the S&P 500 to the CRB. And again, you have this clear trend from 1999 to about 2011. You got this first peak, that's when oil peaked on the CRB. It's a major component, but then you actually finally topped out when gold peaked in 2011. If you recall, John Paulson actually did very well in the gold market during that period. And by the way, he's very bullish on gold. We had a deflationary period. During that deflationary period from about 2008 or 9 to 2020, you had great performance in terms of the S&P, and commodities did lousy. Now I think that we're in this new cycle, which is going to be like that 1999 to 2008 period, and commodities will outperform. Now, the most important commodity relative to the CRB is West Texas Intermediate. And we had a huge move in the 1970s. It went from 24 bucks to 140. And then it declined from that peak in 1980 down to a bottom in about 1999 when it got back down to $20. Then we had a big move on the upside till 2008 when it got to about 174, 175. And then it again declined during a deflationary period, bottoming in 2000. And to me, we had a big run, and it recently pulled back in the last year and now is starting to head north. I think that underinvestment in green and brown energies is going to lead to higher energy prices across the board. and that will be inflationary. And I think that that represents a potential risk. Gold, just again highlighting the deflation, inflationary periods. And during the inflationary period of the 70s, gold actually moved 1,800%. Somewhat artificial because they artificially held the price at about $35 an ounce, and then they let it trade freely, and it went all the way up to, I guess, 677. But 18-fold, that's huge. But then you had a period of consolidation or decline during the deflationary period of the 80-90s. But then another big move during that 1999 to 2009 inflationary period. And gold during that period went from 256 to 1,800. And it's gone sideways, not unlike the 70s and 80s. And I believe that that's going to break out. It's going to break out on the upside, and that's going to be driven by a weaker dollar. But what in particular is starting to catch my interest is the recent reversal in the CRB. And that has gone from, it had a big run from about 2000 to last May. That's when energy prices peaked. But backing up and having, again, a longer period perspective, from the 1999 to 2008, you had a huge run in the CRB. Again, you had a big run, a pullback, and I expect it to move higher. Philosophically, what we're looking at a new normal. What is it? I would be in high yield. I'd be in money markets. I'd be in gold, energy assets. So I'm saying out with the old. I think stocks and bonds and real estate, the 60-40 asset allocation, I think those methodologies are stale. They don't make sense. And I think you want to be in gold, commodities, high yield instruments. I think money markets, 2-year treasuries, emerging markets, small cap value. And I like this idea of maybe a 25% cash, 25% commodities, 25% stocks, and 25% bond kind of asset allocation directing portfolios. With regard why cash, I mean, we heard Tina, there is no alternative. Cash is trash. Not anymore. We work at Interactive Brokers, and our clients are getting 4.58%. Well, there was a period, Ron Welburn is a strategist, many of us know, who used to write the monthly letter. He was a chief investment strategist over at Merrill Lynch Asset Management. And he used to comment, he said, it's a great disservice to retired people what the Fed is doing. He would say this over the last several years, particularly last 5 or so, because retired people can't put money in a bank and get a livable wage. Well, now they have a livable return, and that's starting to cause problems, and it's causing problems for banks. And the fact of the matter is, maybe having a much higher amount of cash right now makes sense, and particularly if things don't do well in the equity market or the real estate market. And so 25% sounds, it's not a precise number, but it's to really suggest that we're in an environment where thinking a little differently is important. I tried to quantify outperformance of large cap tech relative to energy. And I did that in the 99 to 2008 period. And during that period, the triple Qs returned on an annualized basis -3%. And then the XLE, the energy ETF, it was up 22% on an annualized basis. And if I'm right, that's the kind of performance allocation I see going forward. And that's a 25% annualized delta. That's just huge. And but then during the period from 2009 to 2022, you didn't want to be in gold, you didn't want to be in energy, and to stay out of them and be into the S&P, the Magnificent Seven, the FANG stocks, you just printed money. Well, I think that period is turning over, and I I would be inclined to be looking at shorting some of that. I am not alone here. One of my co-presenter, my good friend, Richard Gula. Rich, you're on mute. So get ready, but you're still on mute. I'll let you know when we can hear you. I'll speak very positively until you get off.
I'm on.
Okay. So let me talk about Rich Gula. Rich Gula worked for two icons in the industry. One was Ned Johnson over at Fidelity, and he ran special projects for him and kind of was his go-to guy. He set up the modern chart room, and damn, you get a little bit of an echo, I think. But he also went to Harvard undergrad, grad, and studied psychology, which I think is important because I think psychology is a significant factor in market behavior. But Rich also worked for Dean LeBaron, a famous billionaire, a pioneer in quantitative trading and indexing, and taught him some valuable lessons. And he also ran billions over at Putnam. Anyway, I'm getting some background noise, but go ahead, Rich. Why don't you tell us what your charts are telling us?
All right. The first chart, I first like to welcome everybody to the continuation of a bull market that started in 2020, which is not, I've seen one LinkedIn fellow with some reasonable competence in terms of presentation talk about that. I would argue that the 2022 decline was a violent correction in a bull market that had as an overlay, and why it made it into a atypical chart experience was that you were unwinding quantitative easing globally, or you were seeing the effects of having it in there, and then the second time around you're seeing the effects of money in the system that suddenly got very frightened by the bond market because of the volatility that came in, and therefore the ETFs. The nodal point, the major juncture was October 12th. It's about as famous as that day back in 1998 when long-term capital didn't quite collapse everything, and the day that the margin call on the hunt in the 1979 didn't crack the market and destroy some firms. But on that day, there was chaos in the British market, British pension market, because of volatility in the long bonds that suddenly were putting them underwater. There was a single report I saw that they had called, BlackRock had called and said to the British government, if you don't do something, we're not going to trade, whatever that meant. And I can't remember anything like that in my experience where a firm got away with that. But that was a turn where money was put back into the system. But the European stocks had bottomed in September. Bonds bottomed in October on that day, as did a large part of the kind of broad U.S. market. And then the semiconductors actually took another couple of weeks before they bottomed out. So, excuse me while I'm at a restaurant where people are beginning to kind of assemble, but hopefully it won't be too noisy. Anyway, you're watching all this in motion right now, and it's the latter stages of it, even though I'm seeing more and more discussion from folks in the media that are arguing that now you can relax and everything's going to be just fine because you've got you see that print of lower inflation at last. I'm going to go over here.
Our roving journalist, Richard Gula.
Anyway.
Okay.
Now, which is always the worst represented the Dow is the worst representation, yet it's the most widely advertised, but it captured it pretty well.
Next.
You can see that I put V's in there where you've got 4-year lows. Next chart. Can you hear me?
Yes, next chart.
Yep.
S&P 500.
All right, there's the S&P. There's that V is the low for the 2020 market. And the you're continuing on now with the issue is whether you're going to be able to take out that high. But anyway, just keep that in mind. And I circle down the bottom. Very simple indicators to show you this, but you do macro indicators, meaning a whole variety of cross assets at lows, and then as you get into the cycle, you do things, but you're looking for the rotation by sector. So, all right, next chart.
Mid cap.
The mid cap shows you the QE bear. If that's what's happening in the mid caps, it's still got some evidence that you're not seeing a recovery there, but mid caps would have been fragmented badly over the last 5 years. I've worked with two mid cap managers over a 20-year period, different times, and they both argue that mid caps are either small caps that have succeeded or large caps that have failed. I don't think there ever been, there are very few mid cap IPOs. So how do you get there? And this is all judgment on S&P. And I say I put QE bear as a tongue in cheek. I don't think it. I think that it's a QE bull that is now unwinding, and that's going to be a serious overhang as we go forward. Next chart. We'll get to stocks quickly. The Nasdaq. Why? This is the first time I've ever seen a chart service that had a chart go off the scale, and they didn't do anything about it. See the little peak there in the Nasdaq. When I worked for Oxley way back, which is one of the managers that I had the most fun with, but was the most under the radar. Their annual Christmas card one year, because IFA had gone down for so long, showed the head of marketing doing a presentation to a client that was asleep in a conference room, and had a chart of IFA going down and then going to the floor and going sideways. Of course, as he continued the chart, and he said, and of course, we're quite excited to see that IFA is bottoming now. And here, you're seeing a kind of strange acceleration and a visual picture that's quite remarkable. So down the bottom, if you notice the little momentum, the simplest momentum is not showing anything resembling a top yet. This could be a very strange bifurcated market between Tyson's commodity stocks, which I've got lots of. I'll explain how we came to the same conclusion without talking about it, and a continuation of a mania probably into the Nasdaq 50 that keeps propelling all ETFs that are linked to that group of stocks higher, because the public is going to come in now. If you get a bond rally, if you take the 10-year back through 4 down to 350 or something like that, everybody's going to go buy stocks. Okay, here we go with stocks, I think.
All right.
Next charts.
There you go.
All right. Here we go. First ones. There's the problem here is it's a little blurry, and I'm trying to read your. Anyway, I know these are all drillers, and regardless of their quality, these guys are in orbit right now. Next chart. Here you're seeing there's a little more. These are the late rotators, but still showing plenty of activity. You're always very conscious of volume down the bottom, and I'm using a different service because it allows you to see things differently. But I'm always running OBV charts, and I know that last time I checked, all the OBV charts were showing the same thing. This is serious money. This isn't the retail money.
So what are
next
these
chart.
names? Because it is tough to read. These are just
Well,
energy stocks, correct?
hold on. Yeah. These are all energy. Hold on. I can go.
Well,
Uh,
we got a few to go through, but
yeah. We got for these are we're all this is everything related to range resources. I love range resources. I've followed the stock forever, and it constantly does exactly what it just did. Uh, the it goes to some extreme low, and then the stock goes up 20-fold. So in the old days, Jerry Jordan, who was one of my mentors, which I don't talk about very often, but he was very helpful to me earlier in my career for a long time. Um, he said he made tons of money in the drillers of like Smith International. Every time the market bottomed, he just would leverage himself completely into those stocks, and they always ran tenfold when everything else went up twice. So, all right, next chart.
real estate.
We got a little bit of a real estate look here. Not because real estate per se, I couldn't find a good chart of the BX. It's a core in this market, the BX and the MBB. MBB is the mortgage-backed security ETF that trades very heavily, and BX is the commercial real estate, Blackstone. But I'm putting these up because anybody who's a serious investor who wants yield has these yields sitting there. They're double the 10-year. And it's a little bit of a contrarian play, obviously, because your headline news is basically saying the world has come to an end in commercial real estate in New York City and elsewhere, that buildings are empty and so on. And the Blackstone chart says that's over. Somebody's buying it, and it's working out. Next chart. This is just a yield chart. You could buy these things, but you know what? Doesn't matter if they fluctuate around as long as the dividends are safe. This is sort of two. These were warhorse stocks during my career. Anybody who did kind of staples and conservative stuff got involved in both of these companies. Albemarle, as I pronounce it, and but International Flavor and Fragrances, they look like they're going out of business. So there's a real dissecting going on, and realize that the price of these two stocks are quite, they're respectable, but they're not $300 or $400 or $500, which is what many stocks are. I could do a one stock. I was once asked in a job interview if I used one stock to time the market. It was in the early 80s. And the guy expected me to say General Electric or IBM. And I said Teledyne. And I actually got the job because of that. You might remember Singleton played all kinds of games. He was sort of the Musk of that era in a strange way. And Teledyne was selling in the 200s, and it had 20-point leaps in the option strikes. These guys are under intense pressure. Nobody's buying this segment of the market selectively. Next chart.
Materials and containers.
Yes, this is saying, hey, listen, there's nice rotation in here. The given that I once played a lot of football, I remember the symbol BALL easily all the time. So I always look at the stock. And later on, by the way, I in a previous life, we managed at Battery March a great contrarian portfolio for Raytheon, and we had great meetings with them. And I'm feeling old because I didn't know Raytheon's symbol had changed from RTN to RTX. So I'm feeling a little shy here, but these are all familiar names, and these guys are doing just fine. So the way you map this, I'm gonna take a hard look at a couple of data services that allow you to see the mapping of stocks into ETFs and vice versa. And I would be wanting to look at all four of these names and to find out who's buying them, because those ETFs are going to go up and they're going to draw money in. The ETFs are pricing stocks right now, not the guy that runs. Maybe the guy Contra at Fidelity still has some sway, but nobody else does. Next chart.
Gold and precious metals.
Gold and precious metals. The only problem with gold and precious metals is that I find that everyone's logic is spot on. The problem is the market is not listening at the moment, or at least the buyers aren't. The other argument here is that there's somebody selling their gold, and somebody's sitting in there and they're buying it up. And the stocks, I realize these are the producers and so on, but the gold complex is under a very long-term accumulation. These are not terrible charts. That's why they're yellow. If it's yellow and green together, it means that that's a little better than the other three. But those aren't bad. I would, if you're a gold bug, then you could be buying these guys in the weakness regularly. Next chart.
Steel.
Well, steel. Why is steel going up? I suppose it's infrastructure. You can go back, go get a good CFA level 2 person to read the 5 annual reports and then write it up and then go online and Google it. You probably will overlap quite a bit. But if you're thinking core commodity basic, then you're owning steel stocks right now. You got an overweight. Next chart.
I don't know.
Here, these are all defense. These are all defense stocks. This is how I found RT. I had to go look up RTX. I didn't know what it was. There's RTX. It looks to me like only one contractor stock is getting bought. Is this suggesting that we're going to what? Biden supposedly was looking for another tens of billions for the Ukraine. Is this saying that we're going to wind down the wars? That would be one way of interpreting what you're seeing here, because these are not good charts given where the market is right now, and given the sort of inflation number. Inflation number is just going to have people stay positive. I don't know I think inflation's all silos. It depends on what silo you're looking in. I use potato chips. Potato chips are wildly overpriced right now. So next chart.
Okay.
And
That's funny.
what do we got here?
I don't know. I can't read it.
With you, well, they were clear when I sent them. No, this is the let's see. Well, I think these are insurance. I think these are insurance stocks, and I have a sort of a profile on LinkedIn that I'd like to sort of see if anybody will offer me a job I don't want. I've had 5 requests.
Oh, these are insurance stocks right here.
Yeah. Look at the insurance stock. I've had 5 requests in the last month to do because of my background and et cetera, to go and sell life insurance for a whole bunch of different life insurance companies. It's like, I know one guy that I've kind of talked about doing investment stuff with. It was an old pro. I said, what's this all about? He said, high bond yields, go sell insurance. We could create products if we can get 8 and 9% in the fixed income world. But the insurance companies themselves I think are struggling. And that 10-year volatility, I think the 10-year volatility the 10-year future is being used as a hedging device all the time by active people that are really getting stuck here and there. I think it's a miserable time to be an active core bond manager. But all right, next chart.
All right. Dell.
Yeah. This is, I think, is HP here somewhere? HPQ over there on the side.
Yes. HP.
This is sort of your core. This is the core non-sexy semiconductor technology. There's perfectly good accumulation here. If you're trying to make an economic argument that these companies are going to have trouble, these charts aren't saying that, except for wherever it is up there in the upper left corner. That would be a Dean LeBaron buy, but only because and the stock next to it as well. the battery march would dive for these kind of stocks using a screen that the core screen was. It was the first project he gave me when I came in through the door. 6 months, you got to sit around, and then Dean said, "Oh, I've got something for you. Could you use monthly data and create something that will measure negative relative strength abatement?" And I said, "Abatement?" He said, "Yeah, I want to know when things are relatively stop going down. I don't care if they're still going down in price." And I was able to do it. There were some old models that had actually thought about this when people did it by hand and actually drew graphs. And we use that all the time to then say, okay, now we're going to do a fundamental overlay and come up with a strategy as to why these stocks have stopped going down. We had one guy that was expert, John Wagstaff Callahan, one of the great legendary people you've never heard of. John Wagstaff Callahan would read 10 newspapers a day, and he could tell you what the sentiment was on about 200 or 300 stocks. This is all we needed. So anyway, next slide. And you have to tell me what it is because my screen is no clearer than yours.
I don't know what FN is or CTB.
Hold on. I might be able to tell.
CCB, I think. I mean, I'm sorry.
I think this is Crown Core Conceal and stocks like that. Or core production, I call companies.
Sorry, we'll have to chalk this up to. Oh my.
They're ones that get you a lot of there's these are all being bought into some ETF that has found them. And I'm not trying to. If you go through world,
we're having some difficulty hearing.
Mind-boggling. There are 2,000 of them, and you can categorize them a lot of different ways.
Your reception.
Can you hear me now?
A little better.
Are you okay?
We can't see you then. Anyway.
Hold on.
There we go. That looks better.
Anyway, you can see. All right. Here we go. I went to the window to get the Wi-Fi.
All right. Well, I've moved on to the next one,
next
which
slide.
looks like starts with the New York Times. And actually, you didn't have any marks here, so we might.
Yeah, this is saying these are the companies that look. Yeah, it looks like they're going out of business, guys. I don't know, that not out of business, but there may be a whole series of media mergers going on. Where did I hear? ESPN is trying to do something with gaming, or no, Disney, either Disney or ESPN announced yesterday they're trying to do a major deal in gaming, and they're throwing out
ESPN
core relationship. Yes, so ESPN is Disney. So Disney, I'm old enough to say that if you're betting on games and you're 22 and it's your paycheck, there's a level of moral corruption there that I find hard to deal with. But I'm old, and I never did very well betting on anything because I couldn't even do the spread on the Super Bowl. I did get the Patriots right 3 times in the office pool for I think $5. Anyway, these guys are all in trouble, and I'd like to go and go to a nice depth analysis here, not to find out what has gone wrong, but what could possibly go right, because LeBaron would have loved this kind of pool. I'm not presenting it to beat up on the stocks at all. I'm saying 3 or 4 of these are going to do well. The way you do it in the battery march style is you buy all of them and equal weight them. You do not have specific knowledge on any of these companies, even though you have more information on some than others. But as long as you have the same basic balance sheet and income statement data, and you can create your model, you're going to find a way to find them. All right, next. This should only be a couple more slides.
Oh, I guess these got marked up. Okay, actually, I got.
Last but not least. The last but not least is this is an oldie but goodie that's been in every portfolio or talked about throughout my career, and it shows you the problem in biotech, which is, boy, if you don't know how to sell these stocks, and you're running a biotech ETF, you're getting pretty strange. Well, not an ETF, but you want to get your weighting. You're going to have to move your weighting around on this, and most firms are not good at that. So I didn't have the Moderna chart up because Moderna's down the street from where we live, and Moderna got all that good publicity with the good quote unquote vaccine / drug, whatever it was. And Moderna has gone way down in price. So the locals are not making a lot of money in their own company. Anyway, this is the volatility you got to live with, and now it's going down. But doesn't mean anything in terms of overall market structure. It's just a group that trades that way all the time. All right. Thanks very much. I would just, one last comment is you're in the third phase of the rally, is the one where people begin to throw in the towel. And I'm most familiar with the work of Mike Wilson. And I don't know him. I don't see his original stuff, but he was very, very adamant about the market going to 2,200. And he was countered by that young man. I think he's young, but I may be wrong. Is it Tom Lee, who got regular? Right. Yeah. The market was going to keep going. It was going to keep going. Going to keep going. Everybody was making fun of him, and then they stopped making fun of him, but they still don't quite believe him. The danger now is that July was a turning point of easy cash flow. ETFs apparently in May and June had massive cash flows into whatever was running, and now we got to sort that out. So what should happen, barring some macro disaster, and I capitalize, underscore, and italicize macro disaster, you should get rotation now. You should get an attempt at higher highs in most of the averages, but I'm not sure you're going to be able to do it in the stuff that everybody thinks they really understand. So it's the bottom up view is there's not a lot of disasters. I began by going through the old Mansfield's, looking for all the stocks that were going down to see if I could make a case for end of the world, and I could not. We got the publishers and a few others that are in big trouble, but that's selective. Anyway, thank you, Tyson, for the opportunity, and good investing to everybody.
So I'm going to ask a couple people to chime in. Mitch Pelagic, former quantitative strategist over at ITG. He tracks a lot of the currencies and the commodities. Mitch, what are you seeing?
How much time are you giving me? Just so I know how to condense.
5
minutes?
Yeah.
Okay, good enough. I'll do 60 seconds.
All right.
I'm joking. I'll do 2 minutes. Let me just throw in some sentiment macro view that I'm looking at, and then I'm going to give a little bit of a focus on Japan and commodities, and that's pretty much all my bullets for this week.
Okay.
One of the things I was looking at, we're looking at what are the three big factors that were driving the market, and they're pretty much gone right now. One was the China story, which is very obviously not happening. And I think one thing that I would urge for you to follow is the Chinese PPI, not just a good indicator how bad the situation in China is, but it's also a good indicator, a leading indicator of US inflation. Second thing is AI. Okay, I work in this business. Actually, we work very closely with NVIDIA, so I can tell you how much BS there is. AI thing, right now, there is a statistic that pretty much says that if you take away the AI effect, the AI-centric stocks, S&P will be down 8% for the year, which I truly believe in that. And now, and this story actually doesn't hold because I work for a company in UK. We are actually an AI partner for Microsoft, so I really got a good handle with my techies what's going on. One thing that I would follow here, I would urge you, follow NVIDIA's next earning announcement, because next earning announcement, when people realize that NVIDIA is just an empty story, that's going to be a demise of AI and the whole market and the whole 13% spread that was built on this AI story. Very closely watch NVIDIA, because I pretty much know this company. We work with them. We are their consultants. I can guarantee you that they're not going to survive their next earning call. It's not going to be even near the benchmarks that everyone's euphoric about. And they're pretty much what Amazon and Microsoft are for cloud, NVIDIA is for AI. Now, the third story, the third sentiment that disappeared is just the economy. Okay, so I mentioned the CPI of China. I'm not going to get into detail. You all follow what's going on. So basically, the economy is slowing down. And I've been following a lot of these interest rate swaps and whatnot, who are actually a very good indicator of economy. I truly believe that we are going down to 2.5%. All the quant indicators are showing this, including China's PPI, but not for the good reasons, not for the reasons the market's celebrating. I think this is pretty much an entry point to probably a decade-long stagflation that's going on, and how is it going to work out? We really don't know. The problem with inflation here, okay, this is the life story inflation the way I see it. We have the Federal Reserve that's notoriously wrong in everything they do. Remember the famous term transitory inflation? Fine. But one of the big problems when they faced the inflation, the reason they declared it transitory, because they didn't see where it was coming from. This was supply side inflation. They were totally blind for it. In the meantime, during COVID, they created the demand side inflation. So now they're unsuccessfully fighting demand side inflation, and they even don't understand what supply side inflation is. Now, maybe the CPI is going, maybe the inflation is going down, but I'm not so sure about the core part of inflation, because one of the biggest correlations with inflation are the commodities, and that's not going down. In fact, I'm a strong believer that we have a very key turning point in the energy markets right now. Now, those are the three reasons I'm very negative on the market. I'm personally playing it with strictly buying volatility, because I think the volatility is historically and ridiculously low. So I'm willing to take that risk in the markets right now. Now, the three little side things, side satellites I want to mention. Commodities. Okay. So a lot of people are bullish on gold, including you, Tyson. Good luck to you. I think this environment is not warranting it. Technically, looking at money flows, inflows, outflows, I personally think that gold and silver are not going to see a new high in the next few months to few years. They're going to be in a very tough environment. Gold and natural gas and oil. I think oil 80 is going to be the new support. I'm not going to get into details, but one thing, not that we have a long-term problem with supply demand here, which is starting to really kind of have an effect. But there's another issue here going on. Don't fight the OPEC, okay? OPEC gets into a battlefield without financial rationale. It's principle. It's getting the chip on their shoulder. And right now, with this whole Russia situation and China, I'm not sure what's going on behind the scenes. But trust me, anyone from Biden down doesn't have a clue. Okay, so I wouldn't call it. I would closely watch oil.com guys. They really know their shit. They're going to be actually very good to follow. Oil, in my view, is hit an 80%, $80 the support, the new, and everything goes into that trend. Natural gas, there's no way. Right now, natural gas, natural price, the minimum price, meaning for producers to have any reasons of drilling, is 3. It briefly hit 3 today, and that's going to be the new support. All the indications and numbers indicate that natural gas should be 4.7 by this fall. That's 100% appreciation, and I truly believe in that. Now, Europe is the big wild card. Climate, this summer's heated up more than expected. Winter's coming. I think the Europeans don't have their act together again. There are a lot of the gas utilities companies are pretty much out of business or have shut down. They have a huge problem with their reserves, and that's just going to be an amplifier for the whole story. So I'm very bullish on the energy sector, primarily natural gas and crude oil. Now, the one part I really like a lot, I've been looking at, I mentioned to you, Tyson, is uranium. And this is kind of a hidden home run hitter in the commodity sector. And what I was saying for quite a while, pretty much know geopolitics very well. One of the reasons US cannot really push Russia too hard at this point, because there's only one commodity that's not under the sanction list that US needs desperately from Russia, that's uranium. Not just production. Russia's 15% of the world production. 45% of the refined production. Very big issue. Now, when you add to that problem the queue in Nigeria, where France pretty much gets all of its uranium and US gets a lot of it, there's also rumors that China and Russia were behind this coup. Now, there's a lot of really nasty stuff going on here, but US has no option right now. US is pumping up as fast as they can to actually get their own refinement and reserves. And this is going to be finding jewels, finding these small players in this field is going to be critical. You're talking about US and Canada. For me, this is one commodity that has a fantastic potential and acceleration with any kind of geopolitical issues, which are dominating now. Now, last outlier I would mention is Japan. Watch closely Japan. Japan is not more no inflation territory. Problem with Japan is not only they're gonna actually abandon their yield curve control, that inflation's hitting Japan. By the way, in Japan has significantly higher wage inflation than actual core inflation, which is something that if that happened to Powell, he would be screaming raising interest rates. Now, what's the problem with Japan? Not that it has an effect. If interest rates go up in Japan, it's going to actually destroy the whole business model of fixing interest rates in Western Europe and US. There's another problem with the yen. Carry trade. Okay, this is going to cause, if yen starts appreciating, and if Bank of Japan starts intervening, and it starts having this hawkish rhetoric, you're going to have incredible squeeze on the carry trade. And we're talking in trillions. We're talking that could totally disrupt the market and cause the dollar to crack. What implication that will have, we really don't know. We're talking a lot of things that I mentioned here are all non-linear relationships. But I'm just talking about these outliers to watch. Watch the energy sector, watch uranium, watch the Bank of Japan and the yen. Those are three things that could be big spoilers, with the other ones that we know they're gone. Just everyday work and talk from the Federal Reserve is ongoing danger. And the geopolitical issues, they're a much bigger danger. I personally think that we are winding down, and this war is going to have its finale probably by the end of summer, and that's going to have, I think, real nasty consequences if it works out like that, primarily for Europe. Don't forget, that happens now in combination with the winter coming, natural gas reserves, whatnot. Europe is for another perfect. So, I laugh when I see people saying we should buy European stocks. They're relatively cheap and whatnot. And I'm thinking to myself, good luck to you. But anyhow, that's just my pitch and my bullet list for today without getting into any charts or details.
Thank you, Mitch. I do like gold, but I don't love it. I think it'll take a few. We need to figure out when the Fed stops tightening and the dollar starts turning south, I would definitely own it. But I definitely am very keen on energy, and in particular, I'm noticing the move in the TTF, which is the natural gas benchmark in Europe, was up 40%, and there is a strike in Australia, and lo and behold, I'm a big fan of this company, Tellurian, but I think that natural gas is a very interesting indicator. There are a bunch of energy stocks that are turning up, and anyway, Tony Lobier, do you have any thoughts? You're on mute, so you need to get off mute, but then if you'd kindly share your wisdom with us, we'd appreciate it. You're still on mute. Do you know how to unmute yourself?
And
There you are.
Now I'm
Tony Lobier, tell us.
look. I also I like energy. I really like gold because I think if you look at paper money and what's going on with central bank digital currencies, I think the whole thing is a joke, and it's a disaster. Now, I don't know what the timing is. Stuff doesn't act as well as it should. I think there's a big political issue in gold because I think Russia and China are buying, and that means that the Western um, countries are against it. But I think that the big issue that worries me is the state of the banks. And I get stuff from a blogger, Naomi Prince, who used to be a partner at Goldman Sachs. But according to her, the position of the major banks shows a mark-to-market deficit of 750 billion as of the end of 2022. Now, if she's right, it's much more than that now. And you've got a Fed who are, they either don't give a shit, they are stupid, or they're trying to con the markets. I suspect it's the third. So, I mean, I think, I'm really worried about the banks because you've got this tightening and quantitative tightening and mark-to-market issue. You've got the commercial real estate, which hasn't really hit yet, and you've got the people in Washington who are either clueless or trying to con us all. Now, there's one other thing that's kind of struck me, and I think it's interesting, and I think people are getting tired of electric vehicles. And what brought me to my attention was a big price cut that Ford took on its electric F-150 Lightning, which when they introduced it, I don't know, they had huge order backlog. And this is, if this actually happens, and I don't think it's going to happen so much in China, because in China, if the government tells you to buy an electric vehicle, that's what you do. But I think it's happening generally. So I think this could be a real market mover.
So the EVs turning south, you're saying could be a big.
I think people are getting tired of EVs, and
I think the ESG thing is losing its momentum, and I think people are realizing that they've got.
I think the ESG thing has been a joke from the start, but yeah, I mean, the one thing that would be affected by this in commodities is copper, and so I'd be nervous about copper, but other than that, I mean, I'm really afraid of the banks situation, because you've got Moody's downgrade, you got this deficit out there, and you got people in Washington who are either dumb or totally untrustworthy, or both. All of which, by the way, is bullish for gold.
Well, I don't disagree. And I started out with Janet criticizing Janet Yellen's commentary, and I did
Yeah,
get
well, yeah, no, I agree. I mean, Janet Yellen's commentary was ridiculous on the face of it. I mean, if she were remotely honest, she would say, look, you know, they're a private organization and they're entitled to their opinion. So
well, I'll just add to that. One of the people who isn't here, who I do correspond with, is Ron Welburn, and he was the chief investment strategist over at Merrill Lynch. He wrote their monthly letter for years in the 90s, and he actually was hired by Merrill Lynch because in 1986 he was on the cover of Barron's saying what, and the question posed was, why is this man so bearish? So after the market collapsed, they hired him, and he wrote that he's down to two positions and is about 80 or 90% in cash. Now he's a 80-year-old gentleman, I believe, or thereabout. But I think that the risks here are there, and he's somebody who is, you know, cautious. And I talk about 25% cash, and people are like, "Oh, that's crazy." But I think that there's good reason to be cautious. Alan, do you have any questions?
Well, I just wanted to just say a couple of very quick things because I have to run in just a minute. But first, we talk about climate change and EVs and whatever, and then we talk about Janet Yellen and her absolute stupidity. She had an opportunity over the last years to talk about fiscal policy, as previous people in her situation have done, and what she did in other capacities. She let it go. And so she's responsible for all this. To say her own actions are what's caused, and her inaction in just trying to at least jawbone the idiotic Biden presidency into this spending nightmare that we've got here. And so I think talk about the EVs is a little bit secondary. The first problem is there'll be a point in time, we don't know exactly when this crazy budget deficit is going to be the disaster and everything else is going to become trivial. One other, so it's funny, I just put a little blog post on my thing to say that the existential problem we're facing is not climate change. Climate change is 70 years after we have to deal with the first existential threat, which is our debt and deficit. One other thing I just wanted to mention, consistent with, I think it was Tony was talking about it. It's not only that people are tired with electric vehicles. I have a feeling 10 years from now, there will be no wind and solar. I think if you see all of these wind projects that are going down the tubes because they could not possibly be brought in at the cost that they said, everybody's lying about what it's going to cost. And the problem with overruns when you're talking about wind and solar, the problem is that those overruns go directly into the price that people have to pay. It goes right into the rate base. The government isn't prepared now to step up and subsidize in a major way those cost overruns. And so those projects are never going to get built. There'll be no power. There'll be brownouts and blackouts. And my sense, I'm not saying it's 100% chance, but I'm giving it better than 50% chance that 10 years from now, wind and solar will be a thing of the past. And just one final thought that I just had, which I think it's funny. People, the morons that are out there like Biden and Trump who talk about trade deficits, I just think it's hysterical. So they say, oh, trade deficits are really bad, when everybody who studied it at all knows that when the trade deficits go up, we do well. When the trade deficits go down, we do badly. The only time we have trade surpluses is when we're in recession. So these morons that continue to talk about we don't like trade deficits, they really don't, because they don't understand it's offset by capital surpluses and all of that. Forget about why they're so stupid about it, just that they are. But the thing that's interesting about it is everybody really knows it, because the new statistics coming out of China, when we see that China's exports to us are going down, we now realize that that's bad news, and the market goes down when we hear that kind of thing, which is exactly meaning that the trade deficit's going to go down. So everybody knows the trade deficit going down is a bad thing, and yet, you know, you still have these people in politics just showing what a number of you people have said about how stupid the people are in Washington. They're either clueless or really bad people. But, you know, that's it. Just those are the three things that that take up my brain these recent days.
Alan, what is you have a blog? What is the name of it? What's the address?
It's taxpolitics.com, but it's TAXPOLITIX. Instead of ending ICS, it's IX. But just taxpolitics.com. I haven't I have a bunch of things that I'm ready to put on it now, because it's just been I've been very busy. But it's just amazing that you know what's going on now, the cluelessness of the people of Washington. I'll make one other point. If the Democrats win next year, it's going to be a real disaster. They're not going to want to do anything about entitlements, but this business of not of closing all the permitting, whether it's uranium, whether it's the rare earths and the other I mean, we can't. The whole concept of this chips bill, we have a chips bill to give billions of dollars to chip companies to manufacture in this country, and it's never going to get off the ground because they can't do the permitting. They can't do the permitting, and no matter how much money you're going to throw at it, we're still going to get our semiconductors from Taiwan.
Well, I'll tell you one thing that this comes up. I mean, in NVIDIA sells at, I don't know, let's say 50 times earnings. And the only people who can make their chips are in Taiwan, and Taiwan semi sells at 10 times earnings. So, I mean, the whole thing, it's insane. I mean, even forgetting about whether or not, and I agree, I think, I mean, but I don't know anything. It's beyond my capabilities, but I strongly suspect that this AI is complete insanity.
Let me just make a comment to add to Tony and Alan. Yes, Tony's right. EV's an overhype. Yeah, and Alan is probably right, you know, because the only logical consequence with wind farms and solar, unless we're totally insane, is that they just go away. Now, that's one of the reasons I was talking about uranium and natural gas, because the only way you're going to come up to make up for the deficiency in energy, besides the fact that you're going to need 20 years of drilling and revamping capex for oil, is going to be uranium for nuclear plants and natural gas. And we're going to come to this conclusion sooner or later. Question is, are we going to be just shallow or deeply in the global recession and bankruptcy by the time we figure this out?
But Mitch, your point is very well taken. And you know what it all comes down to? The next election, if we get a Republican in there, all the permitting restrictions, if we have a competent guy, that's why I'm really somewhat worried about Trump, just his competency isn't there. But any competent Republican is going to get rid of all these permitting restrictions, and we're going to start going in the direction, Mitch, that you just said. Natural gas, uranium, this is going to be great. If the Democrats get in, the technical term for it is we're fucked.
Yeah, but here's Alan. Just let me make that comment. I totally agree. And I think Republicans, the only ones that could actually get rid of these permits. And Trump kind of ceremoniously did this with those pipelines, literally the first minute he sat in the Oval Office. But here's the problem. it doesn't stop there. You know, we're like the worst cocaine junkie that's dependent on the dealer being China. Let's say that those permits go away. I was just talking to a lot of engineers in my group about it, including about EVs. And their comments is, okay, fine, but who's going to work in these factories? We don't know how to work. We don't have workers. It'll take forever to get them to work. And guess what? They're going to be 3 times more expensive, and they're not going to be half skilled as Chinese. It's not going to happen even if you take away the permits, even if you can actually build the plant and not interfere with the rare yellow frogs that live there. And even if all that happens, we're still going to be so expensive, they'll be probably our own burial ground. So it's never going to happen. We need China. It's just not going to happen. We need China for stuff. We need Russia for commodities. And they got us by the balls on this one. I guarantee you that.
Yeah,
Okay.
let me make one quick comment about that, and I totally agree. My brother has worked in China. His factories are in China. He's lived in Hong Kong since the mid 80s. And he will tell you that the reason we get all of our stuff from China, and why not from India? Why not from Vietnam? Why not from the others? And the answer is, right from my brother, the Chinese are very good at it. They're efficient. Their governments, unlike the Philippines and other places, they don't have their hands out. The corruption isn't over the charts.
Yeah.
My brother works in China and not in Vietnam or India or any place else, because China has, sad to say, the freest economy that he is aware of in the world. They have a very light touch. It's not a government you want to work for the non-economic side. On the economic side, they make sure that their ports work. They make sure that the roads can get your products to the port. They make sure that they're not overburdensome on your dealing with your own employees. They know how, and then they get great stuff for it, because they get all these people like my brother who want to bring their businesses there to manufacture and sell. And by the way, my brother doesn't sell to the U.S. because the U.S. is a terrible place to do business because of the corruption and whatever in trying to import stuff into the U.S. He sells mostly to Europe and Asia. So I get a real sense of the world from somebody who has been there for 30 years and has been very successful.
Final questions, comments?
Yeah, there's one other comment I'd like to make, and that is the Federal Reserve idea of getting down to 2% inflation is completely nonsensical, because you had 2% inflation before this mess started. And now, in addition to everything else, you have a war in Ukraine, inflationary. You have this idea that you need to repatriate manufacturing and everything else, very inflationary. You've got the whole thing with China, very inflationary. Plus, the government has a deficit of $1 trillion a month. And if that isn't super inflationary, I don't know what is. So the point, I guess, to be made is that these people are, you know, talking totally through their hat. And I don't know if they're stupid or just trying to con us, or both. But I mean, it doesn't make sense. And that's why I'm starting to worry about this bank disaster. I mean, I hope they don't believe what they're telling us.
Well, I agree with everybody and what everyone had to say, and I want to thank everyone for their time today.
Thank you.
With our visuals, but thank you all again. Thank you, Tony, Alan, Mitch, Rich, Gula, Richard Barsom and his dog, his ham sandwich. I think I saw him eating. Jeff Karp, thank you.
Mang, and it was Sloppy Joe.
Okay, thank you. Scott Osborne, Mark Mancius, take care.
Bye.